we'll get cracking with today's webinar. Now, if you have missed anything or you want to catch up on anything, this webinar is being recorded and it will appear up on our YouTube channel later on today. If you ever missed anything, you can always go back. We've got 5 years worth of content on our YouTube channel. If you want to go to YouTube, search for Harts Limited, you'll be able to catch up there on anything that you might have missed. And it should all be working because I think YouTube's owned by Google, not by Amazon. So hopefully there won't be any downtime there. You'll be able to get straight on and have a look at it. Anyway, swiftly moving on. Disclaimer we've got to do first of all. So the following presentation is produced for general guidance only, and professional advice should always be sought before any transaction is undertaken. Individual circumstances can vary, and therefore no responsibility can be accepted by Harts Limited or any of their affiliates for any action taken by attendees of this presentation. Okay, so we have other Harts online resources as well. We can follow us on LinkedIn. Please do so, because then there's plenty of content going up on there on a daily basis, Monday to Friday. As I've mentioned already, you can subscribe to us on YouTube. So when you miss a webinar, or you miss a video, because we are posting up some videos up on there shortly, then you can always catch up on those videos as well. And we're also on Spotify because we've been doing some podcasts with some people who've seen it, done it, got the t-shirt, and will share their secrets of how they've actually managed to get there and build a successful business. So it's well worth watching some of those on Spotify or listening to them in the car on the way home. So feel free to do so. We've got some next events. We have our business club on the 26th of November at the Holland Hall Hotel in Bollington, which is basically a networking lunch and speakers. This will be the last one of the year. We hold these quarterly, so if you've never been to one, please feel free to join us. It's always a great event, and everyone normally has a great time. Our next webinar is also on the 3rd of December, which will be our budget update. So with the budget in mind, I've got a little bit of an exercise for everybody on the call. In the chat box, I'd like you to put in what you think your top budget prediction will be. What do you think Rachel from accounts is going to actually do in the budget? And then at the end of this session, the end of this webinar, we'll reveal what we think she's going to do, and we can perhaps compare some notes. My colleague Chris Bentley is also going to be presenting, who's tax director here at Harts. He's also going to be presenting on this webinar. He also refers to this as the nightmare before Christmas, which remains to be seen. That said, I have been talking to a number of people, including financial advisors and so on, and no one's ever really seen the amount of speculation that's been going on before a budget such as this, and everyone has never been dreading it so much as this one, because we all realise she's got to raise so much in taxes. But let's see what your budget predictions are. Please put in your top budget prediction in the chat box. I'll give you another 30 seconds to be able to do that, and then we can crack on with the main event of today. Just whilst you're doing that, it's just well worth remembering all the services that Harts offer, because we often get asked, or people tell us, we didn't know you did that, which is very frustrating sometimes. So yeah, we're very good at auditing accounts, perhaps sole traders, personal tax, corporation tax, etc., etc. But we also do a lot of business advisory work, strategic planning, business valuations, tax planning. We act as a sounding board for your business, quasi-FD role. Feel free to pick our brains. We've got loads of experience in dealing with a vast variety of businesses over the years, and we probably helped thousands of businesses save millions of pounds over the last combined experience of the people here, hundreds of years probably. So it's well worth, if you've got a problem, just feel free, pick up the phone and give us a call, and we can have a chat through and see if we can help you out. Just as an update, Making Tax Digital, April 2026 for sole traders and landlords. Are you ready for it? If your turnover is 50,000 or above, combined from those two sources, then you need to be in Making Tax Digital. So if you've got a problem with that, get in touch. Companies house changes. The main one at the moment is directors' verification of ID. All directors of limited companies are going to be asked to verify their ID. If you've got a problem, not sure how to do it, we've got a useful video which we can forward on to you. We shall show you how to do all that sort of thing. And then budget day, yeah, we talked about that already, 26th of November. And again, stick your ideas in the chat box. Okay, so what we're going to do now is I am going to stop this and we shall move on to the main event of the morning. And we shall start. Just bear with me 1 second. No, 1 minute. I will just be able to do this. Get rid of that. Just bear with me. Just talk amongst yourselves for a moment. And I want to share my screen. There we go. Right. Okay, so we've already talked about our disclaimer. We've got it up there again for anyone who might have missed it. And then we come on to tax traps for the unwary and what you can actually do about it. Well, first of all, we've got to explain what some of these tax traps actually are. And fiscal drag is a big one. Basically, in as simple as you can get it, it happens when your salary or your income goes up, but the personal allowance doesn't. So personal allowance has been frozen since 2021 and will be until 2028 at the earliest. So the current personal allowance of £12,570 would be 15,500 if inflation was accounted for. So what it's effectively doing is, as you're getting your salary increases or your income goes up, you're getting dragged into the higher rate tax threshold, the 40% threshold, or if even potentially even more, 45%. So with inflation and other reasons for pay rises, more people are being dragged into this 40% bracket. But remember, it is only the excess over the threshold, over that £50,270 limit, that is subject to higher rate tax. So it's not the whole lot. The current limit, 50,270, would be 62,000 if it had increased in line with inflation. So as you can see, this is what fiscal drag is doing. We've had high inflation for the last couple of years. It's gradually coming down now, or it's on the way back up again at the moment. So more people are actually paying higher rate tax. So what's the effect of all of this? Well, tax raising is estimated to be 40 billion by 27-28, according to the IFS, the Institute of Fiscal Studies. So by keeping those thresholds the same, if she continues to keep the thresholds frozen, that amount of money is going to be increased even further. There's an extra 4.2 million people will be paying income tax by 29-30. And there's an extra 3.5 million paying higher rate or additional rate tax. So you can see that it's very beneficial for the Chancellor to keep these rates frozen, because by not putting up the main headline rate of tax, it is actually dragging more people into paying the higher rates and the top rates of tax. And according to the OBR, our Office of Budget Responsibility, that's equivalent to a 4p increase in income tax. So you could say, well, yeah, if she'd put the rates up, the thresholds up by inflation, we could have kept the income tax rates the same. But in keeping them as they were, she's effectively putting this up by 4p in the pound. The state pension is also going to be greater than the personal allowance by 27-28, meaning that pensioners will pay tax on this. It does, being the ultimate cynic here, are pensioners working people? Probably not. And is that who she is targeting? Remains to be seen. And it's not only income tax that's been affected. There are a load of other thresholds which haven't changed. So one threshold has been the same since 1981, gifting £3,000 for any reason for inheritance tax. You can give away £3,000 for any reason per person, and that benefit should be worth £11,500 today. The inheritance tax nil rate band of 325,000 has been the same since 2009. The extra allowance for passing on your main home has been 175,000 since 2020. And the IHT threshold is frozen until 2030, and its scope has been expanded, as we've all seen, with unused pension pots being brought into the scope for inheritance tax, and business property relief and agricultural property relief being reduced. And the £100,000 limit at which you start to lose your personal allowance has been the same since 2010. Other allowances have been cut as well. Dividend allowance and capital gains tax and annual allowances have also been cut. So as you can see, the combination of all of those is contributing to the nation's coffers in a significant way, and she only has eyes on increasing that amount. So what other factors are getting affected? Chris, child benefit. You're on mute.
Thank you, Stephen, for pointing out I'm on mute. So child benefit, it's a technical issue, but it causes an awful lot of problems. So for the last 10, 15 years, there's been a tapered withdrawal of child benefit from higher earners. The last government noticed it was causing a problem and changed the thresholds. It now kicks in when one member of the household has earnings over £60,000, and all of the child benefit is clawed back once one member of the household has earnings over 80,000. So, as we've said on the slide, the withdrawal applies to one or either parent of a couple living together. So this can give some strange quirks. So you could have two parents, each earning 60,000, so total household income of 120,000, and they keep the full child benefit. The next house next door has, I'm going to say, a single parent who earns £80,000. That house next door, no child benefit whatsoever. There've been a lot of tax cases on it. It's usually been related to husbands and wives not knowing what each other's doing. That's where most of the cases have come out, because it's assessed not on the person who claims the child benefit, but who's on the higher earner. So you can see lots of permutations around, I didn't know that husband, wife was claiming child benefit, or not realizing who was actually the higher earner. So widely perceived to be an unfair charge, but it's been there and for a number of years, and I can't see it moving away or being worked in any way differently anytime soon. So next slide, Stephen. So things actually get worse for parents at this point. 60 to 80,000, you can easily be facing an effective tax rate of 60 to 70% by the time you put in income tax, national insurance, child benefit withdrawal for 2 or 3 children, and on top of that, increasingly student loan repayments. If you get to 100,000, position gets even worse. It's not just that you lose your personal allowance. At £1 for every £2 you go over the 100,000, which gives an effective rate of 62%. You also, if you've got children, completely lose your entitlement to tax-free childcare. No taper. One person in a household earns 100,000, the other earns less. £2,000 per year per child available in childcare subsidies. £100,001 of income, all of that disappears. Similarly, for those who've got children of preschool age, most children between 9 months and school age are now entitled to 30 hours free childcare. However, again, if one person in the household earns over 100,000, you could well be losing £6,000 plus per year per child. So there's a huge incentive there if you if you have children to keep your income below 100,000. We'll come on to that later. Next slide. And then once you get over 125, 140, the top rate of tax at 45% kicks in. In some ways, if you've been paying 60% below that, that almost seems like a relief.
Crazy. The rules are crazy, but that's how it is. Don't shoot the messenger.
Yeah.
So, what can we do about it? We've got 12 potential options for you here, and we're going to go through each one and have a look at each one and see how you can use these to actually reduce your potential tax liability. All of these, it's all vanilla stuff, it's all bog standard stuff, but if you combine to use them as much as you possibly can, then you potentially can save significant amounts of tax. So the first one is make personal pension contributions. What that actually does is it extends your basic rate band. So the current basic rate band of 37,700, it will be extended by the gross amount of the contribution that you actually make. So for example, you can make a pension contribution of £8,000 in a year. The government top this up by £2,000, giving you a gross contribution of £10,000. So you can now earn £60,270, being the 50 grand and the 10,000, before you hit the 40% tax bracket. So it's very tax efficient, and you are saving for your retirement. And if
I'll
you,
add this, Stephen, can I just jump in that it also works for the child benefit withdrawal as well, that one?
yes. So again, you can use that to maintain your child benefit. And it's always worthwhile checking how you're getting on during the year to see whether you've got excess or surplus cash that you can put into your pension fund that you pay personally, because it has this effect of extending the basic rand and keeping you at the basic rate threshold. You can put in up to £60,000 into your pension scheme in a year, and you can use up previous year's unused relief. To do that, speak to an IFA. We're not qualified to give investment advice. We don't give investment advice. And if you're already a 40% taxpayer, you can use this to actually generate a tax refund, because what that does is you're also automatically getting the top up from the government of 2,000. If you're a higher rate taxpayer, you will get a £2,000 refund back against your tax, because you will have paid tax at the higher rate already as part of your salary. So making personal pension contributions is a number one way of actually potentially reducing your tax liability. I know it's something that I've done over the years, and I'm sure many of you have done over the years, but it shouldn't be sniffed at. Number two, use the tax-free wrappers that you have. So tax-free savings interest you can earn in a tax year is set at £1,000 for basic rate taxpayers, £500 per year for higher rate payers. And this has not changed, and nothing for top rate, but it's not changed since 2016. So because interest rates have been relatively high over the last few years, and you can still get between 4 and 5% on your savings, many people will already be generating that sort of level of interest. It doesn't take much to get that level of interest. So make use of the tax-free wrapper, your ISA. It's all tax-free, and you can invest up to £20,000 a year in there. So it's well worth protecting your savings from the taxman by using your ISA. Again, speak to an IFA who will be able to determine whether you can have a cash ISA or a stocks and shares ISA, which one's best for you. But it's well worth making use of those. There are times where you might need the cash. You can always just dip in and take it back out again. It's not tied up. So use the tax-free wrappers that are out there. Chris.
So another one is gift aid donations. I'm sure a lot of people do give a small amount to charity, and some people give a much larger amount to charity. Some people might want to give to charity. It's tax efficient. So for those of you who are making small donations, make sure that you remember to claim the tax relief on them. The tax relief way works in the same way as it does for pension contributions by extending your basic rate band, by extending the child benefit threshold, the 100k threshold, etc. So your donation of, say, I'm going to say £40 a month because the maths is easier, will be topped up by the government to £50 a month. Or your annual payment of £600 is worth £750 to the charity, which is what you want. And also you get the tax relief on that £750. So similar to pension contributions, the higher rate and top rate taxpayers can actually use your gift aid, use your charitable gifting to reduce your liability and generate a tax refund. There are a couple of strange things around gift aid. If you're a non-taxpayer, then just be aware that your charitable payments under gift aid will mean that you get a tax bill instead. That's because the charity claims back tax from the government on your donation. If you've not paid that tax, then the government asks you for it instead. So if you were a non-taxpayer and you made that £600 donation, then you'd get the tax bill of 150 because the charity will still get 750. That might be what you want. It may well be what you want. It's why you're making the charitable gift, but just to be aware of that. There are other quirks around life assurance gains and gift aid, which are far too complicated to go into on this webinar. But if anyone is doing anything with life assurance gains and wants to know the tax, please discuss separately. And then to move on. Yeah.
Yep. And then this sounds a bit daft, but consider refusing a pay rise. Sounds a bit counterintuitive, but there are some circumstances that could lead to a tax rate of approaching 100%. And I'm sure nobody wants that. Doesn't really incentivize anybody. So as an alternative, ask your employer to make an employer-only pension contribution on your behalf. This doesn't actually count as income, but you get the benefit. Okay, not straight away, but you get the benefit. So, for example, if you're on a package of £100,000 already and you're offered a pay rise of 10%, of that £10,000, you will only receive £3,800, assuming you've not got any tax-free childcare and all that sort of stuff as well, that kick in, because your tax rate at there is 62%. Instead, why not get your employer to pay £10,000 into your pension fund? They also save on the employer national insurance of £1,500, which is 15% on the £10,000. So everybody wins. You get 10,000 gross contribution into your pension fund. The employer saves 1,500 quid, and everybody saves tax. So it's a great way of actually looking at reducing your tax liability, but increasing your retirement pot at a win-win situation for everybody. So have a think about looking at doing that one if you're in a position to be able to do that. Chris?
Yeah, it gets even stranger. We're now suggesting that you reduce your working hours. And you can be better off by doing that. No, this isn't a politician's pre-election soundbite. Work less, have more money. You're not dreaming, nor are you in Alice in Wonderland down any rabbit holes at the Mad Hatter's Tea Party. It doesn't apply to a huge number of people, but for some, you're actually better working less hours and you'll be better off. So, by way of an example, you're working full-time on a package of 120,000 a year. You have 2 children under school age and in childcare, just like the gentleman on this picture. If you go to 4 days a week, you reduce your salary by 24,000. Okay, net pay actually reduces by only 9,100. That's due to the 60% tax rate plus the national insurance on that, most of that salary you've given up. But Actually, by having done this, you haven't lost 9,100. You've now got tax-free childcare for both children. So that's possibly worth 4,000 a year. And these two children are now entitled to 30 hours of free childcare for each of them too. That's probably worth another £12,000. So you've reduced your salary by 24. Your net pay's gone down 9, but you've now got 16,000 of additional childcare benefits for your children. You've now got 1 day a week off work and you're £7,000 a year better off. So that's back to finish with Alice in Wonderland. We'll go back to drawing treacle with the children.
How about that? Crazy rules. We don't make them up.
But there we are. So let's move on.
Next one, benefits in kind. Now, normally a benefit in kind takes the value of the benefit and it adds it to your salary. So you're thinking, well, actually, what's the difference here? But there are some that can actually work in your favour. Company electric cars. These are still very advantageous. Employers will often give you a choice of cash or car. Cash is added to your salary, so it boosts your actual income level. However, the taxable income from an electric car is currently at the rate of only 3% on its list price. So basically, a £50,000 car will only add £1,500 per annum to your income, whereas a similar cash package could be up to £6,000 per annum. The difference may keep you below one of the tax thresholds. So it's well worth having a look and seeing whether that option is available to you, or if you're running your own company and you're looking at taking an electric vehicle, looking at changing your vehicle. Let's see how that could help you. If you're actually running your own company as well, and it's a brand new electric vehicle that you're buying, and more of that later, then you get 100% relief against the tax as well for the cost of the car. So at the moment, electric vehicles very much an advantageous way of reducing your tax. The next way is salary sacrifice. If you're already earning above one of the thresholds, you could ask your employer to reduce your salary in return for making, say, a pension contribution on your behalf. So, for instance, you've got a package of, say, 52,000, that chucks you into the higher rate threshold. You could request a reduction in salary in return for a £2,000 contribution. That way it keeps your earnings below the higher rate bracket. It means as well that the employer doesn't pay any extra national insurance. And potentially, if you're at the child benefit limit, it can increases your eligibility for child benefit. It means that's not going to get clawed back. So again, well worth seeing what salary sacrifice options are available to you from your employer. Chris.
So yes, we're now going to move on to sort of more around timing of income and shifting of income. So previous possibilities all really related to reducing your income or claiming a particular relief for a year. For those who have lumpier incomes or more control over their income, there are other possibilities available. So we'll look first at the timing of income and expenses. It really only applies to those who have their own businesses, but it could also apply to landlords. They're a business of a kind. So shareholders, as the classic example, and we do this when we're completing personal tax returns for people, you want to keep usually a smooth income from year to year to keep your income to a particular level from one year to the next. And that particular level is usually just below the higher rate threshold or just below 100,000, possibly just below the child benefit threshold. So even if you haven't taken quite that amount, we'll probably put through dividends to take you to that amount so that you can draw down on them in a future period. What that does is it avoids you paying higher rate tax or losing your personal allowance in 1 year and then having unused allowances in the next. So that's what we're doing by looking at when dividends are declared and using the opportunity to maximise allowances and shift income into lower tax rate periods. If you're a landlord, you probably haven't got quite so much control over the income side. You want the tenant to be in there. You don't want a void. However, major repairs will reduce your income from the rental properties. So you might look to bring those forward or potentially postpone them from one tax year to the next as a way of shifting the expense to a period when you might be expecting to pay at a higher rate. So perhaps if you're a business owner, you need to take the money out of the company to pay for repairs to the property. You deliberately make sure that the repairs and the dividend go in the same period. If you get them in different periods, you may well end up with low rental income and therefore unused allowances, and then a high tax rate on the dividends in the year before or the year after. So a lot that can be thought through there to avoid paying unnecessary tax. Next one, please, Stephen. And similarly, there are opportunities to shift income around the family. With spouses, that's easy. Spouses can gift shares, can gift assets between them freely, free from capital gains tax. So if your wife or husband's not using all their allowances, you might consider transferring shares in the company to them so that you can pay dividends to them. Similar, if that's not possible, it might well be that the couple's investment assets all go in the name of the lower earning spouse, so that the lower earning spouse can use as much of their allowances as possible. In some circumstances, it's also possible to use the allowances of adult children as long as they're over the age of 18, but would very much say take professional advice with this one first. The income does go to the adult child. You need a means to get it back or a way to cut it off if it's no longer appropriate. We quite often see it being used for university fees, but not generally as a long-term strategy. Spouses, it's pretty easy. Adult children, very much take professional advice first. Thank you, Stephen. So next one is bed and breakfast. No, we're not talking about going away for a long weekend and somehow getting tax relief on that. We've had Alice in Wonderland already. So no, this bed and breakfast is all to do with using your capital gains tax annual allowance. Not as valuable as it used to be. Used to be just over 12,000 a year, now worth 3,000 a year, but you can still save £720 a year as a higher rate taxpayer. Broadly, what it involves doing is selling sufficient assets, usually listed investments, to generate a gain of £3,000, which is tax-free, and then buying something back subsequently. Now, the reason you need professional investment advice is even if you're doing your own financial advisory and managing your own portfolio, there are still tax anti-avoidance rules to navigate around bed and breakfasting. You can't simply sell your shares in, we're in Macclesfield, so AstraZeneca on Monday night and buy them back on Tuesday morning. That doesn't work. There are bed and breakfasting strategies that do work. Hopefully I've covered that one.
Okay, the next one is to make gifts, and this can be used to avoid inheritance tax. So the current rule is you've got to survive 7 years after making a gift for it to be outside your estate, and you can't continue to benefit from that gift. So, for instance, gifting your own main residence home to your children and then continuing to live in it doesn't work. We often get asked that question. But you can give £3,000 a year away for any reason. So a husband and wife can give £6,000 a year. And if you haven't used last year's allowance, then you can use that as well. So potentially you could give up to £12,000 away to your children. There is a small gifts exemption of £250 per person per tax year. And wedding gifts, £5,000 from a parent, £2,500 from a grandparent, and £1,000 for anybody else. So it's a way of gifting money. The main one, which people is often forgotten about, is the normal expenditure out of income. Now, you can give a regular gift made from surplus income. That's not capital, but that doesn't reduce then the giver's standard of living. So, for instance, you might be a pensioner sitting on a large pension pot and thinking, I don't need all this income. You could withdraw an amount from your pension pot and say, I only need so much for this to live off and give the rest away. And as long as you can document that and you can show there has been regular gifts out of income, then that's another way of you disposing of your pension and getting around the inheritance tax rules. But again, take advice on this. Inheritance tax is a quite complicated area. We haven't touched on the use of trusts here as well, which can be quite complicated. And for the final one, Chris.
Going abroad. There doesn't seem to be a week that goes by now when I'm not dealing with inquiries advising a client on the possible tax consequences of going overseas. 5 years ago, that just didn't happen. To be honest, even 2 years ago, it was very much the exception rather than the rule. People are going abroad all over the place. It's not just the usual, it's tax havens. And to be honest, it's probably the minority that are looking at going to your usual tax havens. Yes, there are those looking at Dubai, but we've seen a lot with Portugal, Malta, Cyprus, the Isle of Man. I've even had Sweden. There were family connections, but I've even had discussions about Sweden. There are a lot of hoops to jump through with gaining residence in the other jurisdiction. These will depend on where you go and also whether you've got ties or other ways into that country. If you are thinking of going abroad for tax purposes, assume that you'll be very limited in the amount of time you can spend in the UK, especially in the first 2 to 3 years after leaving. The UK has a statutory residence test. It is complicated. Quite often you end up counting the number of days that you're in the UK and the number of days outside the UK. There are 5 different tests, and depending on how many of those tests you make, that will determine how many days you're allowed to spend in the UK. And there are different rules applying depending on how many years you've been out of the UK. So complicated, and you do need to take advice, but as a planning assumption, if you're thinking about it, just work on the basis that you can spend a very limited amount of time in the UK, in the opening years in particular. Is that right for you? That's only a question you can answer.
Okay, thank you.
So, yeah, that's probably it, isn't it, on that one? Going abroad. Yeah.
So a couple of other bits and pieces as well. So we've got other traps, cars. We've seen a lot of this over the last 12 months or 2 years or so. When you go and buy an electric car, and people often ask us to say, is this all right? And they get some advice before they actually go and buy the vehicle. A lot of people don't. There's a difference between what the dealer might say is an HP agreement and what is actually applicable for tax purposes. And you have to look at the balloon payment at the end to determine whether it's actually in reality a lease for tax purposes or an HP agreement for tax purposes, and there is a big difference. If it's an HP agreement, effectively you buy the vehicle, you get the allowances in year 1, 100% allowance on the electric vehicle. If it's a lease, you get it over the period of the lease, so it can be 3 or 4 years. So you need to look at the balloon payment at the end. Is that the value you would expect to pay for that sort of vehicle at the end of a 3-year period? Or is it significantly less? If it's the value you would expect to pay and the agreement has a mileage restriction of say 10,000 miles a year, then for tax purposes, it is a lease. It is not an HP agreement. So what you get from the dealer may not be the same for tax purposes. So just be aware of that. So if you want any further advice, again, drop us a line, give us a call. The other trap is in relation to VAT threshold. People always think, well, I've not hit the threshold, so therefore I'm all right. And they only look at it once a year. The turnover threshold currently is £90,000 per annum. The rules are, it's when you expect to go over. At that point, you need to be VAT registered. So you need to be looking at a rolling 12-month period. It's not just your accounting period. So are you approaching this, and is it even worth going over? If you're only dealing with VAT registered customers, then you may as well be VAT registered. Inflation means that you could also get caught out in this fiscal drag, because as you put your prices up, your turnover increases and you're more likely to hit that turnover. So that comes to the end of this part of the presentation. Has anybody got any questions that they would like to ask? Please feel free to unmute yourself before we actually go into what we people think is going to be in the budget. Anybody got any questions? Please free to unmute yourself and shout out.
Stephen, do you want
Yes.
to stop the recording at this point?
Yeah.
And then, so certainly before we start speculating on the budget.
Okay, so we're going to stop the recording now. Thank you very much indeed for joining us today, but we will carry on afterwards. Bear with me one moment.
But could I also ask whoever